So, why do some stocks just seem to work while others don't? It's the billion-dollar question, the puzzle that has kept financial researchers up at night for decades. People have built countless models trying to explain it. But the market, well, it always seems to keep a few secrets up its sleeve. Today, we're diving into a new model that claims it's found a huge missing piece, one that might just change the way we look at stock returns for good. All right, here's our game plan. First, we're going to run through something called the anomaly gauntlet. Then, we'll bring in a new contender, the Q5 model. We'll pull back the curtain on its secret weapon, expected growth, before we throw it into the ring for an ultimate factor face-off against the reigning champs. And, of course, at the end, we're going to crown a winner. So, I want you to picture the world of asset pricing, not as some stuffy academic library, but as this absolutely brutal racetrack. Any new theory, any new model that wants to be taken seriously has to survive this track. And let me tell you, it is packed with obstacles designed to make it fail. Now, what are these obstacles? Well, in the finance world, they're called anomalies. Basically, they're patterns in stock returns that, according to all the old textbooks, just shouldn't be there. They're the market's little quirks and weird behaviors, and any great model has to have an answer for them. And look, we are not talking about just a few little quirks here. Researchers have found 150 of these things. Think about that for a second. That's a 150-lane racetrack. A new model has to basically win in every single lane to prove it's the real deal. To give you some perspective, even one of the most powerful models out there, the original Q-factor model, stumbled. It failed to explain 52 of those anomalies. It was a true champion in its day for sure, but an imperfect one. And that left the door wide open for a new challenger to step up. And that challenger is the Q5 model. You know, it was built for one reason, to go back and conquer all those anomalies that its predecessor couldn't. And it does this by adding just one single new ingredient to the original recipe. And what's so powerful, what's so elegant about this is its simplicity. The original Q-factor model already had four really solid ingredients: the market, size, investment, and profitability factors. The new Q5 model just adds one more thing to the mix, a factor for expected growth. That's it. One change. So you've got to ask, right? Why this specific ingredient? Well, it turns out this wasn't just some random shot in the dark. There's a really powerful economic theory that suggests expected growth has been the missing puzzle piece all along. This quote right here gets straight to the heart of it. To put it simply, investment theory says a company's future plans actually matter a ton right now. If a firm is signaling, hey, we're going to invest, we're going to grow like crazy, well, it needs to offer a higher return to convince investors to come along for the ride. It's kind of like a premium you get for betting on their ambition. But how do you actually measure something as fuzzy as expectation? Well, the researchers developed this really clever three-step process. First, they hunted down the key financial clues that best predict a company's future investments. Next, they built a forecasting tool to give every single stock an expected growth score. And finally, they built the factor itself by creating a portfolio that, buys the high scores and sells the low scores. So what were these magic financial clues? A few are what you'd probably expect. Things like market value and recent profitability. But one predictor really stood out from the pack: simple operating cash flow. Turns out the amount of cold, hard cash a company is generating from its main business is one of the absolute best signals of what it's planning to do next. And just how powerful is this new factor? Well, on its own, this expected growth factor earned an average premium of 0.84% per month, from 1967 all the way to 2018. I mean, that is a massive return. It tells you this factor is capturing something very, very real that other models were just completely missing. All right, so we've got our new challenger all powered up with this potent expected growth factor. Now it is time for the main event. We are lining up the Q5 model against the most famous, most powerful asset pricing models in all of finance to see who really comes out on top. And the competition is absolutely fierce. You've got the legends, the Fama French models, including their latest six-factor beast. Then you have models from Stambo and Ewan, which are all about finding market mispricings. And another from Daniel, Herschelfire, and Son, which is based on how investors think and behave. Each one has a totally different theory about what makes the market tick. So the stage is set. How did these competing models actually do when we threw them into that 150 anomaly gauntlet?
This is the ultimate stress test, the moment of truth. Okay, first, let's just quickly remind ourselves of the baseline here. We're trying to improve on the original Q-factor model, which, remember, was already a top-tier performer. That model, for all its strengths, still left 52 anomalies totally unexplained. 52 puzzles left on the table. That is the number to beat. So, what happened when the researchers added that one simple, theory-backed factor for expected growth? They put the new Q5 model to the test, and the number of unexplained anomalies dropped to just 23. It literally cut the number of unsolved puzzles by more than half. I mean, that is a stunning, game-changing improvement from just one single factor. And when you see the results laid out like this in a chart, the victory is it's undeniable. The Q5 model left only 23 puzzles unsolved. Its older brother, the original Q-factor, was stuck back at 52. And the world-famous Fama-French six-factor model, it couldn't explain 74 of them. In the asset pricing Olympics, this was an absolute gold medal performance. But the real question is, why did it win so decisively? Well, it's because the expected growth factor solved puzzles that have stumped finance experts for years. Take R&D spending, for example. It hurts profits in the short term, right? But it's a massive signal of future growth. The Q5 model finally gets that trade-off. Or look at accruals. That's when a company's earnings on paper look good, but their actual cash flow's low. The Q5 model understands that's a red flag for low expected growth. It just connects the dots. So if you boil this all down, here's the takeaway. For a long time, we've been looking at a two-dimensional picture of the market, investment and profitability. What this expected growth factor does is add that crucial third dimension, a company's future ambition. And with that, we get the most complete, the clearest picture of what drives stock returns that we have ever had. And that leaves us with this final, really fascinating question to chew on. If this new, more complete model can explain away all these patterns we used to call anomalies, were they ever really market mistakes? Or were they just a rational payment for a type of risk, the risk of a company's future growth, that we just didn't know how to measure until now? And if that's true, what does it even mean to beat the market if the map of the market itself keeps getting better and better?